Good afternoon, everyone. Welcome to True Potential's The Weaker Markets. I'm Matt Henderson. I'm one of the portfolio managers here at True Potential. I'm joined by Joe Ford, my colleague, and he is one of our investment analysts. So in these videos, we like to start with how markets have performed over the past week. So if we start with equity markets, it's been a positive week for equities. We've seen them up 1.7% with the US and emerging markets leading the way. If we look at what's happened within bond markets, we've had credit spreads move lower. That's in line with what we've seen equities do and how they've traded over the week. But we've seen sovereign bond yields move higher. US Treasuries up about 7 basis points. UK gilt, so sovereign bonds here in the UK, are flat over the week. But there's been quite a bit of volatility over the period that myself and Joe will cover later on in the video. And if we look at currency markets, we've seen sterling weaker against the dollar, the yen and the euro, but once again linked to a point that we'll bring out in this video. So Joe, what's been happening this week with the US and tariffs with Donald Trump?
Yeah, so just today actually the US government has started sending out letters to other countries to inform them of their tariffs and the rates they'll be getting. Now they expect to get all these letters sent out by the 9th of July. However, they'll actually come into effect on the 1st of August. So it gives a bit of time. It means that it'll probably rush countries into getting these trade deals across, which is a good thing.
Yeah, because we've already seen the likes of the UK and Vietnam come to these agreements. So as you said, I think it's a strategy from Trump to try and bring some of these countries to the table, because he's basically saying, if you do nothing, this is what the consequence of that's going to be.
Yeah, exactly that. And, the only thing I would say is the range that Trump sort of suggested is quite wide. So it suggested it'll be between 10 to 20% and then 60 to 70%. Now, when Liberation Day happened, he indicated that the maximum would probably be around 50%. Yeah. So that higher end of the range that is mentioned there is actually higher than what was initially suggested. But, hopefully these trade deals get across. It just means there'll be a bit more clarity, a bit less uncertainty around these tariffs.
Yeah, and I think what markets are also looking out for is some of the US key trading partners also come to the table. So we've mentioned the UK and Vietnam. We've also seen tensions with China de-escalate and agreement move in the right direction. But we're yet to see anything from the likes of Europe, Japan or Korea, have we?
Yeah, and Japan has been in the news particularly this week, just around this. They're so auto heavy that they're really keen not to be nailed by these tariffs, and really they'll be looking to protect themselves from any sort of large tariffs that Trump puts on them. Yeah,
and I guess the other thing that we've started to see come through from the US administration is the passing of his self-called Big Beautiful Bill. So really that's just focusing on further tax cuts and deregulation in the US. So once again, that's all been positive for US equity markets and why they've been towards the top performers this week. Joe, so we mentioned that in the UK there was a bit of volatility in the UK gilt market. Can you just give our audience a bit of an idea of what's been happening there?
Exactly. So on Wednesday, Keir Starmer had his Prime Minister questions, and there was just a bit of doubt around the future of Rachel Reeves. And really this moved the gilt markets because the one thing Rachel Reeves has had in place as Chancellor is the fiscal restraints upon how much the UK government can borrow. And, with concerns around her future, it could be that a new Chancellor would come in and actually not have these restraints in place. Yep. So, there wouldn't be this limit on borrowing, and it just could mean that, essentially it's made gilt yields move higher. But then, since then, we've had Keir Starmer's come out on Thursday and said that actually Rachel's here for the long run. Yep. And you've seen these gilt yields just come back down again. So they've almost round-tripped over the week, really.
Yeah, so I guess markets are worried, in essence, that if Rachel Reeves did step down and a new Chancellor comes in, there's more unfunded spending, which leads to more gilt borrowing, higher supply, and therefore gilt yields have risen. But as we see with these kind of short-term political events, over the long run, they usually resolve themselves, which is what we've seen in a pretty quick order with gilt yields rising. I think on the day they're out about 15, 16 basis points, which is actually quite a large move for the sovereign bond market to see. But actually the day after, when he clarified she's here for the long run, markets got a bit more happy with, borrowing shouldn't balloon out of control, and yields came back in. Right, perfect. Thanks, Joe. And finally, yesterday we had a bit of news out of the US in terms of labour markets. What are we seeing there, Joe?
Yeah, so we had some data come through earlier in the week, and that was the ADP employment report.
Yep.
And initially, so that's a bit of a softer measure. It's kind of a bit more of a survey measure. And
markets kind of use it as a forward,
yeah,
or like an indication for what we might see in the NFP.
Exactly. So the ADP actually indicated that we're going to lose jobs in the US, which is obviously is not good for the labour market. But then as the non-farm payrolls came in yesterday, it actually added jobs, and it added 147,000 jobs, which is much more than what was expected. So
yeah, it was about 105,000 was expected.
Yeah.
So about 40,000 more jobs than what markets had anticipated might happen.
Yeah, and this is a bit of a theme that we've definitely spoken to before. So as the effects of tariffs come in, you'd maybe expect some of the data to weaken, and it has done in some of the softer data like the ADP reports. But then when it's come to the harder data, such as the NFPs, we've really not seen this weakening come through yet. And it is something that we'll continue to monitor over the summer as the tariffs get implemented more and more.
I think as well, what will be another important indication for us as an investment team is we're right at the very start of the second quarter earnings season within the US. So at the minute, we've only had a very small sample of companies report, about 18. So, there's not many conclusions that can be drawn from that pool. But what will be interesting to see is this is the first update we'll have from US corporates after the tariffs have been placed in by the US administration. So as you say, we're getting indications from survey data and things like the ADP that the labour market could be weakening, but actually when the hard data comes out, such as the actual labour report, we're not actually seeing any cracks yet. So that'll supplement those other bits of data that we've got, just seeing what corporates are saying. Are they seeing pressure on supplies, on labour, on earnings from the tariffs?
Yeah, and in terms of what market analysts are saying after Liberation Day, they revised their estimates for this year right down for corporates, but then actually we've seen a bit of a bottoming.
Yeah.
And those estimates from analysts are actually starting to tick up, which is a positive sign.
Yeah, I think that's an important point to highlight, Joe, that actually markets seeing all these tariffs come in, we've taken our estimates down, but actually as things have started to improve, they've also said actually things maybe aren't as bad as what we thought they might have been. So we're just starting to see analysts get a bit more positive on the earnings from the US. Perfect. Thank you very much for that today, Joe. And thank you everyone for watching today's video. We'll catch you on Monday morning for morning markets.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value and you may get back less than you invest.